Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hi, everyone. I'm Zach from Earmark, and I'd like to welcome you to today's webinar, Aligning with Private Equity, Transform Your Accounting Firm for Acquisition Success. And I'm going to hand it over to your instructor for today, Dave Bunce from Interval. Dave, please take it away.
Awesome. Thanks, Zach, for that intro. And thanks, everybody, for tuning in, either live or on demand after the fact. It's great to be presenting this topic to you today. We're going to dive into a few things around the role of private equity in the accounting industry right now. And I'll give you some stats to show that this is very much real, just in case you haven't heard some of the news and rumblings on where private equity has invested heavily into the accounting firm industry right now. Then we'll talk about building a firm that aligns to those expectations. What can you do to make your firm attractive to a buyer, whether that be PE or a larger accounting firm? And we'll talk about some of the differences and nuances between those two buyers as well as we go through this. Then we'll also talk a little bit about how to evolve the practice from a tech perspective and an operational perspective to prepare yourself for an acquisition as well. So a little bit about me before we dive into that. My background is in public accounting. I'm a CPA by trade. I spent 7 years at one of the big four firms. After that, I left to run a professional service firm, a marketing agency. So if you think it's hard to get accountants to do timesheets, try to get marketers to do timesheets. But that's a different topic. So when I was at that marketing firm, we successfully acquired a couple of agencies. We then also ultimately got acquired into a roll-up strategy by a private equity firm, where I was part of the due diligence team to further acquire 10 more firms. So after going through that journey, I joined Interval earlier this year. And Interval is an accounting software platform focused on business valuation. So nice blending of my background in public accounting, along with the M&A and experience with buying professional service firms from marketing, and now bring that all together with my experience and role at Interval, where I'm the director of partnerships. So let's talk about a little bit about the problem and what we're seeing in the accounting firm industry. Consolidation is beginning is the simple way to put it. We are seeing private equity investing in the big firms. As you can see here, 5 of the top 26 firms in the US have had PE investment in the last 3 years. And there's this push and pull or sort of race for revenue as we see private equity become involved. Obviously, a firm needs to hit a certain level of revenue threshold to be interesting to private equity. That needs to be at least 8 figures or more typically. And so in order to get to that size, the natural path to it is acquisition. So firms are doing their own M&A activity to get to a size where they are attractive to a buyer, whether that be another strategic firm or private equity. And so you have this pull of private equity coming in. That means firms want to get bigger, so they're buying up smaller firms. And it's this kind of chain effect that we're seeing. And in fact, 40% of the top 100 firms in the US have bought other firms. So very acquisitive market. And I think why that's a bit of I know we said it's the problem. And I do think it's a bit of a problem because the mid-market firm is in danger. And what I see it as is you're either going to get big enough to get acquired, or you are going to shrink and be a boutique firm. And I think those that are already in that boutique space, local firm with a small team focusing on a few clients and servicing them very thoroughly, I think those people are safe. And that boutique level of relationship and involvement in the operations, think sort of pseudo family office, those are safe because you can't replicate that level of relationship at a PE level. And we'll talk about how PE can change sort of the servicing model. But those boutique ones are safe. The large firms are just going to keep getting larger and add revenue at a higher margin to their book of business to help them cover their operating costs that are usually fixed, right? And that's why the race to revenue is so important, because you have this overhead cost that can be very easily covered by adding more revenue. And so as you add more, that fixed overhead cost becomes a smaller percentage of revenue. You make more money. And that's really why PE is interested in the accounting firms. And so here's some of those kind of reasons we're talking about of why this is happening and why are there so much acquisitions happening in the accounting space. So the first thing is accounting firms are very resilient. Death and taxes are the two certainties in life, as we say. So we know that accounting firms aren't going anywhere. We do know that there's a sort of commoditization or a race to the bottom on pricing of some of those services, especially commodity type compliance work, such as tax returns. So we'll get into how we differentiate offerings for sure. But in general, accounting is a very resilient industry. We know it's going to be needed. And that's attractive to have a book of business or be invested in an industry that has very inelastic demand. The next reason why PE is interested in this is firms have been run like lifestyle businesses. The number of either personal expenses that run through accounting firms when there's one or two or only a few partners, you look at sort of the approach to running an accounting firm that's partner led. It is very much viewed as I become a partner. I'm a partner for 25 years and I grow my practice and then I retire and hand it off to the next generation. It is viewed as that, as opposed to a traditional view of I'm going to grow this business for 5 or 10 years and sell. And I think that is starting to evolve a little bit now that there is more M&A activity. But historically, kind of what I'll call a lifestyle industry. And part of the reason why I think there's a challenge in that is this succession planning of, well, I'll just hand it off to the next young partner and he'll pay me for the business and him or her will pay me for the business and they'll run it. And so that's not the case anymore. We have the lowest CPA acceptance classes coming in a long time. In fact, at AICPA Engage, they quoted that it was about only 1 in 19 business students are pursuing specialization in accounting. So once you take that, 5%, call it, and apply the drop off between deciding to write the CPA exam, passing the CPA exam, and getting and maintaining the professional requirements, it's a very small population. Not to mention just demographics of, the baby boomer kids have all kind of come through the profession now, such as myself. And we're now into the millennial generation, which just demographically is a smaller group. And so you have this issue of the next generation's not there, or they looked at what was happening and weren't really interested in taking it on. So firm owners aging out, books of businesses that are sitting there, looking for somewhere to go. And that's where a lot of this acquisition comes in as well. We also see historically a lot of manual processes. We think of accountants, whether it's fair or unfair, as the people with the green visor and the bean counter kind of names and such. But there is this connotation in the industry that it is a very manual process. I, as a CPA, still print things off. Even though I work for a software company, I will print a piece of paper and look at it. And there's a lot of digitization that can be done in our industry. And then finally, the future revenue forecast looks strong. And so you have this confluence of these client lists sitting here and partners that are aging out. But the revenue that can be generated from that book of business is very valuable and lucrative coming forward. And so PE sees that and says, we can come in and take advantage of this opportunity. We can arbitrage that to say, people want out, they have an asset that's valuable, and we predict it's going to become more valuable. So the next question is, why do they think it's going to be more valuable? Why does revenue forecast look strong? And this is why. We are sitting on the precipice of an incredible amount of wealth transfer. This is just from M&A activity of other businesses. This is the amount of small, medium-sized businesses that are expected to sell over the next decade. And when we look at it that way, and demographically it makes sense, just like the partners at accounting firms are retiring and aging out, we see a lot of that within the SMB owners sphere. And so you have all these sales of businesses that are expected. And who makes money when somebody sells a business or plans to sell the business? Accountants, along with M&A advisors, wealth managers, etc. And so by PE positioning itself as a acquirer of firms today, they're getting in on this curve at a very good time, because they know in the next 10 years there's going to be tax and succession planning, estate planning. There is going to be M&A advisory work, value creation services, CAS services, all of these offerings that build value around the business and the wealth that can be created from selling it. This is why PE is most interested in the accounting firm space. And this is why revenues look strong. So I was talking a little bit about the table stakes versus the differentiators and how to set your firm up for attractiveness for a PE. And what, as I said, a PE firm or another accounting firm that's larger, what are they actually buying when they buy a firm? They're buying two things. They're buying a client list, and they're buying the people that do the work. And so what they're going to assess on that client list is, how long have they been with you? How well have you done growing them or retaining them? How well have you done at selling your other services to them? And how have you moved beyond the commodity of compliance? And the reason why they look at that is they want to know, A, is this client or this client list willing to spend money on value-added higher margin work? And B, they want to know this because they want to assess the sort of the efficacy of these differentiation services. Have you proven that your tax planning engagements are successful? Have you proven that you can move a client through to M&A? They want to see these case studies or proof points in your client list so that they know when they buy it, they can do the same with their methodology. I split this up as well because the table stakes pieces are where there is more pricing pressure right now in the market. And this is what I was saying about those mid-market firms that I think may be in trouble, is if they stay in this table stakes category. Because as the firms grow and as the businesses grow, they need these differentiators. They need effective proactive planning. They need somebody to help them with succession. They need to have these conversations about where's the business going to go. So if you're not offering those differentiators, you're at risk of getting your market and your clients cannibalized by people that are. One thing on the mid-market firms that I do think is an encouraging sign that I certainly value from a firm perspective would be the alliances and networks that you can be a part of. I'd highly suggest that is the defense or the moat of the mid-market firm, to say we are part of this larger thing we can tap into. We have best practices. We have shared or leveraged technology capabilities. Whatever that looks like is how you can move into offering some of these differentiated services or having the backing of a larger group, but still maintain some of your independence as well. But this is the key here, really, is the compliance is table stakes. We know that the PE firms will already have people that can do this, but how you're going to differentiate and add value is through what increases the value of your client's business. So value creation, tax planning, succession, and M&A. So once PE enters a market, what happens? And this is to say, where are we going to see accounting firms evolve over the next 5 or 10 years? The first thing is we see that there is an investment in technology to support the ecosystem. So PE has shown up. They've started writing big checks to buy firms. In order to get a return on that, what are they banking on? They are banking on being able to do more work with less cost, right? Those are their only two levers. We need to either increase revenue and or reduce expenses to generate that revenue. In order to do that, one of the natural places they look is technology. And especially when they are acquiring businesses at scale, one investment in technology can support a wider range and a larger base of revenue. So the efficiency being gained is on an amplified amount of revenue, which is why technology is so important, right? One-time fixed cost approaches or very scalable SaaS offerings will allow them to get that efficiency and or grow their revenue without the same amount of people power. Because of that, we are seeing an increased level of activity from VC firms investing in accounting tech. And so when you look at the proliferation of solutions that accounting firms have at their disposal, whether it be practice management, revenue operations, insight tools, there's a ton. And it's only expanding. And I think we'll get into how to assess technology before the end of the session. But it's something to be aware of, is there are more and more options out there. There are more and more ways to use technology to grow a book of business and or reduce expenses. And those things will need to have to be managed effectively in order to build up the return that PE is looking for. The other thing that happens next is the change in business model. As I said, accountants and accounting firms are historically a very lifestyle-based business where you have partners basically running the show. And the partners are these generalists or expected to be these generalists who need to generate new business, who need to execute on the current work and be technically sound enough to sign off on that work. They need to be good at building client relations, and they also need to be good at retaining talent. I know from my experience at PwC, there are people that are good at one of those four things, two of those. It's very, very hard to find a partner that is good at all of those things. And I always felt like it was trying to fit a square peg in a round hole when you would ask a technically focused accountant to go out into the market and find new business and bring in the next new client. There was a bit of an odd balance in that. And I think where PE is going to go is truly changing the way the leadership of firms work and moving away, to some extent, from that partner-based, relationship-based approach, and rather finding the expertise in each of these functional areas to service the work. Because they're cheaper, frankly. You can get, account executive salespeople that are cheaper than a partner in terms of expectations or draws or what they would want to earn, and are probably better at bringing in new business anyways. And vice versa, if there's partners that don't want to be signing off on all the compliance exercises, but are doing it right now because they have to, but they're really good at relationships, that poses risk internally to the firm. There's all sorts of different challenges with that. So I think what we're going to see is more of a specialization and focus on what a partner does or what functional area they sit in. And I think we'll see more non-technical, functionally based staff coming in. For example, account management is a great example. The number of times where the person doing the work, who is a qualified CPA, who there aren't enough of anymore, is answering all the client emails and doing the resourcing and scheduling of the staff. All of those sorts of roles just don't make sense for your essentially your rarest asset, which is the CPA who can execute and sign off on engagements, also doing the administrative function of things. And I think that's going to change, and it's going to have to in order to create that efficiency that the PE is looking for. We've already seen the third point here start for sure. Again, when I was at AICPA Engage, the number of outsourcing or offshoring solutions was vast. There's more and more of them popping up. They are getting more expensive, still less than if you're looking at doing everything in-house and onshore, if that's a word, onshore, but not offshoring it. So I think that is already happening. There are also shared service centers, even in North America, where all of this type of work goes to one shared service center where it's trained. Picture like a call center, but for confirmations or for testing AR collectability and subsequent receipts, if you really want to get into the technical of assurance engagements. But those are already starting to happen, and I think that will continue to happen, because that, again, is how the efficiencies are going to be created. The final thing of what happens next, if you will, is those who stay get paid. So there are usually, as I said, there are not enough CPAs to do the work right now. And we know that PE firms that are coming in are incentive-based and focused on generating return. Much like I've seen in the marketing space, when you join into these PE firms or get acquired, there are usually very meaningful compensation structures that are focused on growth and retention of business. And so there is that pyramid function, but those who stay will reap the rewards if you're willing to go through that evolution of changing from lifestyle business to a PE-based business. If you're willing to learn and embrace technology, if you're willing to adopt a new service model potentially, there will be rewards at the end of that. But obviously that comes with time and also change management. So as we said, what would PE do? And we'll go over some of the things they're looking for. I think there's a bit of a choice firms have to make right now. It is, do we want to get on this train or not? And even if you don't want to sell to a PE firm, you will have to start acting, looking like that kind of firm in order to compete. And that is just kind of the reality of it. So we view it as, if you do these things that make your firm attractive to a PE, you don't have to sell, but you will be generating a better return, and you will be more protected, or you will be more resilient as a firm because of it. So whether you're looking to sell or not, there are some things that need to evolve in the firms that I think would be of value for everyone to consider and look at. So this is where private equity sees value and where they would come into play. I think the first one, client retention, that's kind of a minimum, right? So if we look at valuation of accounting firms, we all know it's sort of some multiple of revenue, anywhere from as low as 0.5 to as high as 1.5 or 2 times revenue. But there's just a generally accepted rule, 1 times revenue plus or minus a bit. That's where a lot of these things come in to impact which way do you move on that scale. Do you get to move up on the revenue multiple or down is dependent on how well you've already built the firm to meet the expectations of private equity or another accounting firm looking to buy you. And the first one is client retention, because as I said, they're essentially buying a book of business. They're buying your client list. That's it. And a name and a reputation, which oftentimes goes away, frankly, after 1, 2, 3, 5 years, where it becomes, powered by whoever or a part of this group. So really, client retention, if they're buying the client list, client retention is very significant. A firm that has 80, 90, 100% retention is going to get a better multiple. And so when you look at that client retention rate, what are some of the things you can do right now to improve that? Well, some of them are on this slide. So you can ingrain yourself with multiple lines of service per client. Now, obviously, there's some independence things that have to be considered. If you're signing off on audit engagements, then you need to be aware of independence rules. But in general, the more lines of service or the more engagements you're offering your clients, the better. And that will help retain them. It will also help grow your average client value. Because what we're seeing is, and this is all firms right now, is everybody's doing the same exercise of who are my A, Bs, and C clients? And how do I get my Cs to be Bs, my Bs to be As? And if the Cs aren't going to become Bs, how do we get rid of them? And I know I'm talking about client retention. I think what's important is it's ICP retention, or it's retention of air quote good clients. It's setting yourself up to say, these are the clients we want to keep because they pay on time, because we do multiple lines of service, because they're growing at 10% a year. All of those metrics go into forming kind of that account prioritization. And if you can say, hey, I'm retaining 80 or 90% of my A and B clients, and for the C's, we're either shifting them out or pricing them out or whatever it might be, that's okay. That can be accepted. It's when you don't have that plan or that mapping and you end up losing focus on your top accounts, that's when it hurts you from a retention standpoint and a metric perspective when assessing the client book of business and the value of the client's client list. The other thing that is valuable is recurring revenue models. So obviously we know that there is a busy season for accountants. We know that comes every year when it's peak assurance time and then into tax time. The problem with that is the carrying cost of the people to do that work in that peak time is high when you have to carry them through summer, fall, etc. And that's why some of those shared service offerings or outsourcing or offshoring really becomes attractive, because it allows for more flexibility in your capacity and resource planning. But another way to combat that is creating recurring revenue models. And firms that have been particularly active in M&A space lately, whether that be acquiring or selling, there's a disproportionate relationship to how much of a CAS practice they have. And I think having that recurring revenue is a very valuable thing, because it A, flattens out some of the resourcing needs you have. B, it's stickier in some ways because you are more entrenched in the financial success of the business. And then C, if you can show the repeatability, it will give more confidence or value to that client list. So having that CAS model, having that recurring revenue is very significant. And we'll talk a little bit more about forming that up in a second. We already talked about multiple lines of service per client, so I don't think we need to hit on that one too much. Growth in average client value kind of goes along with that. But how well are you able to pass along cost increases to your clients? If the average wage is going up 5%, are you able to capture that 5% in the growth in your billings and engagement fees? Or are you losing that? Because what we also know is, as you model that out, it creates sort of diverging lines, right? Where you're seeing cost increases and you're seeing revenue drop or revenue downward pressure on price or target rates or recoveries. And that those two lines kind of crashing together would not be good. Lower cost of labor, again, how are they going to remove some of the non-specialized work from specialized people? Going out and hiring even an entry-level CPA has continued to get more and more expensive. In Canada, where I'm based, that market in the last 5 years, an entry-level CPA salary has gone up about 25%. So pretty significant. And this is going to need to be something that gets looked at. I think the more you can find ways to move the work off of the specialized resources to non-specialized, the better. Then we get into process automation. A few kind of key tips here of what an acquirer is looking for, or what can even elevate your firm to the next level. And again, at the marketing agency I was at, I was the chief operating officer, and my role was to make sure we had documented how does the work get done, because we know there's employee turnover, we know we're trying to grow. So how do we deliver a consistent offering, and how do we not lose continuity and consistency when people leave? The amount of time firms spend, and I can even think of my own experience, but the amount of time firms spend, trying to catch the next person up on a file and trying to get that handoff when people leave, it's significant amount of time. So the more that you can move process and workflow to automated approaches, or at least digital processes, the better. And the way to start that can be a manual exercise in some ways, but mapping out all of your key processes, just like we would suggest for clients, right? I remember doing planning for clients when I was in assurance, and you had to know and understand, how do they collect money? How do they buy their inventory? How do they control the payroll costs going out the door? That start to finish, how do we onboard somebody, etc. That's what firms need to do for themselves, is sit down and map these things out. Pick your key business cycles, typically, new business through to cash collection, or revenue and engagement signing to cash collection. There is resourcing and delivery. How do people get assigned to do the work? How does the work get done? Where does it get done? And then ultimately the onboard, offboard of people and the growth and development of them, your talent life cycle management. So map those things out, current state. You identify the gaps. You build the process the way you want it. Then you identify, only after you've mapped it out, then you identify, where can technology fit? Where do we have the ability to have automated controls or IT dependent manual controls along this way? And once you've mapped that out and implemented it, we'll talk about implementing tech and change in a second. But once you have that sort of codified, you're really able then, when somebody comes in to look under the hood, you're able to hand them your playbook. You're able to say, this is how we do business. It's consistent, whether it's this associate or that associate doing the work. Whether we have turnover or not, we are giving you something that shows we can do this on a scalable way. That is worth something to the acquirer. And again, if you're not looking to sell, it creates efficiencies in your business. So do it anyways. It's kind of the answer. But those are kind of the steps. That's how I'd work through this process automation point. And then finally, as I said, once you've done the process automation, you can then look at technology. And this is where Interval comes into play as an insight tool to apply against your client book of business to understand where the opportunities are. And I won't go into my whole Interval spiel and demo. We can do a demo another time. Feel free to reach out or check out our website. But the insight tools and the ability to mine your client's information for revenue opportunities, for retention opportunities, that there's incredible value in that, because you can show that the discovery process, the new business process, the strategic planning conversation, that can all be done with technology, as opposed to relying on the manual processes that we talked about accountants are so well known for. So some best practices to cover off here. I know I mentioned CAS being one, and I get a lot of questions on this one. We were at a conference earlier in the year, and the number of people that came up to us that said, I know I need a CAS practice, or I want a CAS practice. Don't know where to start. I have 300 clients I'm doing tax returns for, but now what? What do I do with that? How do I evolve from grinding out 300 returns over 4 months of the year and then doing nothing the rest of the year? And I'm doing nothing's a bit exaggerated, but you get my point. And so how you do that, how you define your CAS offering, there's some great content and webinar out there that teach that. But what I really look at is, first off, what type of CAS do you want to offer? Are you looking at being a fractional CFO and bookkeeper? Are you looking to be a high margin or sort of value add CAS practice where you are essentially guiding them as a business owner through strategic planning exercises and that sort of thing? Those are two very different realms. One, such as the bookkeeping, fractional controller work, heavily automated, volume based, package based. We are going to sell, to our clients $500 a month. We're going to do all of your accounting, bookkeeping needs. We're going to put in a bunch of automation, and we're just going to churn, burn through kind of clients that way. Or, we have this bespoke offering where we're high value or high margin consulting work or advisory work, where we are going to help you plan, go through a strategic planning process. We're going to build 5-year forecasts for you, and we're going to be alongside you for your growth journey. Two very different things. So define the scope, step one. Define what you want that offering to be. Step two then is test and validate that in the market. What are people willing to pay? Who else is out there? What are they charging? Do your existing clients find value in what that scope is? So move into test and validate the market. Then you build the processes in order to execute it, and finally bring in the team to do it. Again, the team looks very different depending on the scope. So start with scope, validate that, build out the steps, then you bring in your team. And when I say processes, I'm also talking about technology as well. So get your scope, get your market validation first before bringing in tech. And that's a mistake we see a lot of firms make. The number of failed sort of implementations of software over the years I've seen is significant. And part of that is because technology is brought in to solve a problem that technology alone cannot solve. There is change management needed. There is process definition needed. There is scope definition needed. And technology can't do those things for you. Technology can allow you to deliver what you want more efficiently, but it can't decide what you're going to offer necessarily. It can't validate your pricing for it either. So getting that right first and then bringing in tech is really important. Once you do bring in technology into the equation, though, there's kind of two ways you can monetize that. And this creates great margin and some recurring revenue for you as well. But you can include it as part of a fee increase. So what we've seen a lot of our accounting firm customers do is they'll say, our cost this year for executing on your tax compliance work or your assurance engagement is going up 5% or whatever it might be, 10%. Realistically, they're just trying to cover the cost of the salary increases. But they can also say, as part of that, though, we've invested in new technology and you get to see some of that, or we pass that benefit on to you, such as Interval, for example. So you can use it as part of justification for a fee increase. The other way technology can be used is individual SKUs. If you sell on packages or plans, this is a great way to do it, where you can say, as part of our pro offering or as part of a one-time engagement, we are going to run through a strategic planning exercise with you where we look at the business valuation and financial health of your business. That's going to cost, $2,000, $3,000, whatever it might be. And the cost of the time and the tech is really only $1,000 or $500. That's the way you build up margin on an individual SKU basis if you're going to use tech there. So, as I said, getting into tech adoption and helping understand how to implement things successfully. First off, defining the objectives and requirements. Our CRO always says tech has to do something. It needs to solve a problem. So defining the objectives before you go and look at, what technology is going to be helpful, or before you go and pick a software to implement, define the objectives and requirements. And that's why I said that process mapping is so important, because you can go back to it and say, okay, here's a gap right now. In our client life cycle, we have nothing. Once we send them the tax return that we did for them, we have no touch point, no value add. We don't do anything to foster growth in that client for the rest of the year. There's no client life cycle planning. Okay, that's a gap in our process. How do we close that? Well, we need to find a way to talk to our clients about something other than just compliance and tax returns. Okay, we need to talk to them. What are they interested in? Wealth creation, M&A, et cetera, et cetera. Okay, now we know we want to add something that allows us to give and deliver insights to our clients that are going to help them understand how well their business is performing or how much is their business worth. Okay, now we can go and look for a piece of software that does that. We've defined the objectives and the requirements, and it's based on a need identified in the process flow of the business. So defining that first and foremost before you go and assess software options. The other thing, and as somebody who is responsible for helping sell software, this one is a little bit ironic that I'm saying it, but assess software options collaboratively. As much as it sometimes is painful to go through 2 or 3 demos where you're bringing on different people and you're bringing in a broader team and they don't know what's going on necessarily, but you're bringing them up to speed, and then there's 5 people in the decision and all of that. There is value in bringing in multiple people from the firm to assess software options, and that is very important. Defining their purpose or getting the cross-section right is important, but saying, in order to effectively use this tool, we need these people bought in. And again, that goes to your process mapping. If we need a tool that's going to help close the gap on client service once we've delivered a compliance exercise, okay, who needs to be in on that? Well, we need the partner on that, we need the manager on that, and we probably need one of our leaders from another line of service to look at this too, who would be getting the leads or be brought into those conversations. So bringing those in collaboratively and collectively is important. Next, building an implementation plan, pretty straightforward, but setting specific timelines and people and action items. You can do this as a Gantt chart. You can do it as a RACI chart if you haven't heard of that. But the idea of who's responsible for something, who's accountable for it, who's going to support and consult on it, who's going to be informed. Defining what people's roles to play are in that implementation is very important, along with timelines. Timelines right now, just as an aside, are super important because we're in this season right now of, I call it kind of the 90 days that set your firm up for success, because once January hits, it's just go mode, it's work mode. And then we know summer, everybody needs to take some time to reunite with their families and decompress. So really, September, October, November, these are the months where the foundation needs to get built to make sure you're optimally ready to run come busy season. And that's why, the timing of talking about some of this is so important, because now is the time to set the plans and build the foundation for success. Training and best practice documentation, pretty straightforward on this one. Having those best practices, having it overlaid to your process maps, all very important. And then finally, for tech adoption, monitor ongoing value. If you're not getting value from the software, you need to challenge the vendor on that. And I think you also need to define what value looks like. It might not be usage. You might have a tool that you only use a few times a year, but each time you do, you're able to bill a client $3,000, $5,000 for the work you do with it. And it pays for itself multiple times over. So don't conflate adoption or usage with value, but rather look at, what is the impact this is having to your business and monitor that. So just a little bit about the types of data you can use to grow your practice and how you can talk to clients about some of the opportunities that are sitting in the information you're sitting on. So going back to our table stakes and differentiators here, you're sitting on a ton of data about your clients. You need to know what their thoughts are on the differentiators. You do the tax returns. How does a firm move into talking about value creation, tax planning, succession, and M&A? And the answer to that is using something like Interval, of course. But where this really gets important is understanding the opportunities that sit within the information. So this is just an example using the numbers that we've run through Interval. So we've run through Interval $15 billion or more of enterprise value of businesses. On those balance sheets, there was $4 billion of excess working capital. For an accountant, that is a great signal for what do we do with this money? How do we take it out in the most tax effective manner? How do we protect that value? Is there succession planning that needs to get done for this business before it gets even more valuable? And then also, what does the capital structure of this business look like? Do they have sufficient working capital? Do they need loan origination? Is there a banker you can introduce them to? Any of those conversations are valuable. But the point is, if you can look at your book of business with compliance data and move the conversation into differentiators, that's super important. And the opportunities are there. They just need to be unearthed. And that really sort of concludes sort of where Interval plays, is just bringing in that data allows you to expand your LTV. It allows you to get different departments and sink into the client's book of business more. It allows for higher margin advisory work. So we're talking about building out the muscle of working in multiple lines of service and adding value to your client list, and ultimately client retention. So the more you can provide insights and the more you can demonstrate value to your clients that goes beyond the table stakes, the higher chance you have of retaining them, the higher chance you have of growing them. And that's ultimately what we talked about PE looking for and wanting. What does PE look for? They're looking at retention. They're looking at growth in client value. They're looking at lines of service. All that information is sitting in your client book of business to make that happen. You just need to unearth it. So with that, I will wrap things up and say, if there are any questions or any comments, happy to see them, receive them. Here's my contact information. You can follow us on LinkedIn as well, of course, where we post content like this on a regular basis. But otherwise, thanks for listening. Hopefully you found this informative, and we look forward to hearing some feedback.
Great. Yeah, thank you, Dave, and thank you to everyone watching this on demand or live. And here's a quick reminder on how you can earn CPE for watching this webinar.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.